I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRECIPIC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure should be the exact same as yesterday. Got some earnings that are out. Zscaler, beasting, but in the same sector, S getting smoked. Yes, what? What are we saying yes for? What? Oh, Josh was on too? Oh. Yeah. They can hear us both. Josh, busy doing who knows what. Just give me a second here. Alright. I'm like not having a good earnings season. I'm like 1 for 12 on holding stocks into earnings reports this season. This has not been great. Really has not been great. I might maybe 2. I had 2 move in my direction. I had Snap and Chewy move in my direction. Everything else has been against me, but it's the risk of holding stock into earnings reports. You never know. And just give me a second again, please. I just got filled on something. All right. What do we have out after hours here? So Palantir just upticked. They got a second contract. They had news this morning. That was an okay trade today, but still didn't get above 22. Maybe this other contract that they just got from the DoD can help them get through that 22 tomorrow. We got NetApp out. All over the place, this NetApp. Widespread, so kind of hard to tell. NetApp beats on EPS. Kind of in line-ish on that range with Q1 net revenue expectations. Same thing with the EPS for their next quarter, kind of within range. What else do we got out here? Salesforce, its worst day since 2004, down 20%. Woof. We got Dell out. Dell getting smoked. What, do they not want the computers anymore? They wanted the computers, now they don't want the computers. I'm not going to bother going through the Dell numbers. We got Marvell out. I didn't even realize Marvell was reporting today. I probably should have known that. Oh, yes, I did. We talked about it in the morning meeting. This Marvell's been one of the best ones, but it's getting hit down here on its earnings report after hours. Revenue looks like it's in line. EPS is exactly in line. They see their next quarter. That number is roughly in line, a very small beat. This Marvell looks like it's pretty much in line across the board with the numbers that I'm seeing. But they got it trading down a little bit, probably just because expectations are so high in the space. Zscaler. They see their fourth quarter adjusted EPS 0.69 to 0.7 million. What? I feel like that number doesn't make sense, but it looks never 69 to 70 cents for EPS is what they're seeing for next quarter. Expectations are 67 cents. So it's a beat. The Z-scaler was super beaten up into this report, getting a pretty nice uptick here. And then in the same space, we got Sentinel 1 out, symbol S. They see their fiscal year revenue 808 to 815 million versus expectations of 816.6 million. So a little bit of a miss there. Not a disaster, but it's definitely a miss. Q1 annual recurring revenue 762 million versus expectations of 765. Same deal, a miss. Not great. So they were pricing in $3.20 move, I think is what what Pat had said. It's not doing that full move here, not yet. But those numbers are definitely a little bit of a miss. Peloton completes their holistic refinancing. Costco trading down here. Costco's been a monster. Costco trade down a little bit. All right. You can pay attention to that. Nothing too exciting happening at the moment. All right, so let's talk about the day. So interesting day, right? Because you got the S&P down 0.8%, you got the Nasdaq down a pretty decent 1.3%, and the IWM is actually up 0.9%. I feel like it's been forever. I know it hasn't been really that long, but I feel like it's been forever that since we've seen such outperformance from the Russell in one given trading session. It's probably a little bit of mean reversion. Just because the Qs have been outperforming the IWM really significantly over the course of the last, well, pick your time frame, and the Qs have been outperforming. Pick any time frame you want, but the last several days, it's been very noticeable that, like, I mean, we talked about that crazy chart this morning, right, of the NVIDIA versus the S&P when you have a top, like, I don't remember exactly what it was, top 5 market cap stock that's up 20% in 3 days. That historically the market is moving higher, and it just makes sense because just think about how market caps work and market cap weighted indexes work. But in this circumstance, we've got NVIDIA up 20% in 3 days and the S&P down about 1%, and that's probably never happened before. So it really just shows you that the underlying of this market, and you can see it more with the RSP and the IWM, has been very weak recently. So today seems like it was a little bit of a mean reversion type of trade where NVIDIA is down, 4.5% or so on the day. So that pulled the Qs back down a little bit. Qs are relatively weak. The IWM's up, and the IWM was helped by a little bit of a bounce back in this TLT. So TLT's up 0.9%. So we got some interest rate relief. The dollar's down. So the dollar's down also tends to help the market. So that both of those factors, probably especially interest rates, helped give this IWM a bounce. But nothing is out of the woods yet. If you're looking at the daily chart technicals, fine, nice little bounce back in the IWM. Happy to hold above 202, happy to hold above 200, but this is a lot of work that needs to be done. You really need this IWM to get back above like the 206 to 207.50 area in order to get healthy, and it's still a ways away from that. It's below these moving averages. That ADMA is declining. The 21's flattened out. They might cross in another day or two if we stay trading below them. And the TLT, which interest rates helped to give some relief to the Russell today, TLT still closed below 90. So sure, nice to get an oversold bounce here, but until you show me that the TLT is really recapturing that $90 to $91 level, it's hard to be bullish on, I would say, equities overall, but especially these small caps, mid caps, long duration stocks, interest rate sensitive stocks. And again, you can see that just with the chart of this IWM, it still doesn't look healthy. But the Nasdaq chart took a pretty big hit. The Nasdaq chart lost last Thursday's low, which we had been discussing coming into today's trading session and pretty much all day yesterday. We were just describing the SPYs as neutral, the Qs as bullish, still holding above Thursday's low, still holding above the ADMA, and the IWM bearish for the reasons that we just discussed. I would argue that the picture of the Qs now has changed to more neutral. I still don't think that you could call this an outright bearish chart. You haven't even pulled back to the 21 EMA. You have the potential of creating a higher low still with the NASDAQ. But it's hard to call the NASDAQ bullish when you had a push-through failure, engulfing bearish candlestick back here last Thursday, consolidated that for 3 days, and then broke down. So I would describe the Qs as neutral. I would also still describe the SPYs as neutral because they are still above 520, but they're kind of getting into a bit of a danger zone here with the close below the 21 EMA and the 80 EMA on the daily chart starting to point down. And the IWM I still would describe as bearish until it can get above the levels that we just described. So the big adjustment, I think, from our big picture perspective or thought process on the indexes is we went from neutral, bullish, bearish, SPYs, Qs, IWM respectively, to neutral, neutral, bearish. So little further deterioration on the market today with that NASDAQ relative weakness, NASDAQ losing that ADMA on the daily chart, losing last Thursday's low. Still don't have continuity across the board. It's still probably more of a two-way market than anything else. There's definitely opportunities for longs. There were some good long trades out there today, some decent ones that we had discussed in the morning meeting. AI was a pretty good trade, albeit tricky. Palantir was an okay trade, though it started off kind of anemic. There are definitely still some opportunities to the long side, but there are also opportunities to the short side. And it's about paying attention to relative strength and relative weakness when you're in these two-way markets. The interesting part about the relative strength, relative weakness, and we identified this in the morning meeting today, so I hope everyone was prepared for it, is that the strength big picture has been in the Qs, and small picture the weakness has been and big picture the weakness has been in the IWM. But on a small picture starting pre-market this morning, that was flipped. Right, pre-market this morning we were getting relief from interest rates, and what has recently been strong was weak, and what was weak has been strong. So today was a little bit of a mean reversion kind of flip trade on that relative strength, relative weakness. And how you should be approaching yourself in a two-way market environment where you can be long and short probably depends on your time frame. If your time frame is big enough, it probably still is these mega cap tech stocks. It's where the relative strength is, and it makes logical sense that that's where the relative strength is based on some of the stuff that we've discussed, them just being multinational companies. They can raise debt in other countries if they want to. They can raise debt in euros at lower interest rate costs if they need to. They have so much cash on hand, and they're locked into really low rates. So, higher interest rates doesn't matter as much for them. So if you're big picture, the relative strength on the NASDAQ is really still where it's at. If you're small picture, if you're just like a pure day trader, then you wanted to recognize, well, on the big picture, the relative strength is in the Qs, the relative weakness is in the IWM, but in the small picture today it's flipped. So maybe I can look for some bounce back trades and some, growth related stocks or in some IWM related names. And that's kind of how it played out. If you look at the small time frames, just look at the relative strength in the IWM, especially in the morning session. Gapped up pretty big. Qs and SPYs actually gapped down. Digested that gap through price and time. This is a perfect little pullback to the 80 EMA on the 5-minute where you get a doji, and then that basically marks the low of the day, and you trend up and grind up for the first half of the trading session before slowing down midday, rolling back down a little bit in the afternoon. The Qs are like literally the complete opposite. The same pattern that I love for long continuation, which is first test of the 80 EMA in a strong stock or market after gapping up. When you get a doji there, this is an opportunity for day traders or bigger picture traders to go long versus this low. It's literally the exact same trade happened in the NASDAQ, but in the opposite, right? You had the gap down, opening sell-off, you went sideways, And then as this ADMA actually catches up, you've got these like pivot highs here that you could be short versus for downside continuation. It's a continuation shooting star upside tail candle into the ADMA for downside continuation. The IWM is a doji into the ADMA for upside continuation. Kind of rare, I think, to see the exact pattern, the exact same pattern, but just in opposites for two indexes on the same day. I know a lot of times we do see, strength in the Qs versus the IWM, and occasionally it's the opposite. But to actually see the same chart pattern, but in opposites, is pretty rare, I think, for the indexes. So the exact same long pattern that's in the IWM is basically what's present in the Qs in the beginning of the day, and then these Qs, and that's pretty much highs. Really weak, put in a deeper pivot low at 11, give a broader bounce, and then kind of rolled over to close almost on lows. A little bit of an uptick when the MOCs hit, and SPYs were kind of a similar situation. It's Palantir's running higher here after hours, not bad. So yeah, that's the indexes right now. On multiple time frames, definitely getting into a little bit of a danger zone here as we're now neutral bearish, and the SPYs are starting to get down into an area that could be problematic if they were to break lower. But we'll see how that plays out. As far as individual stocks go for today, this AI was a focus of mine. It's my second best name of the day. I did pretty well with it. Also not tricky. Not easy necessarily because of the break of opening lows, but that was with a lot of extension. Tailed very hard into this equilibrium area here on that pullback, created a pivot low. You could be long versus that low. I know Rex called it out into the VTF. The problem I felt was just kind of the risk. It was a lot of space risk. The low there was 25.15. I know when he called it out, it was back above 26 at that point. So little tricky of an entry. You had to be pretty quick with that. But if you're able to get stock off that pivot low, it turned out to be a pretty good trade. I had already had some from pre-market and from after the market open, and I used that as an opportunity to be able to add to a pre-existing position, and then it worked great. Worked its way all the way up to $29. I kind of really wanted to keep it. I thought that was a great report from AI. I really liked the commentary that came out of the CEO in the earnings report. And, there's resistance, but the resistance is like the low to mid 30s. I could easily see the stock getting back up there. I just felt that I had too much on my books already on the long side. So I decided to just cut it into the close, take my profits, and run. But that was a pretty good trade. Made a couple dollars trading Reddit again today, but it closed a week. I don't have a position right now. Unity was super disappointing. This thing is unbelievable. What are we, 12 days in a row to the downside at this point? I thought that this was a trigger yesterday when that volume really came in at 325. And then, I was trying to trade okay in the beginning of the day. Even though it was relatively weak, I felt to a lot of other, smaller companies and growthy companies with the interest rate relief. And then it just, there's no volume, and it just kind of hit back down and then got below yesterday's low. So, the degree of extension, the amount of days down in a row in this Unity is starting to really become incredible. You don't see a lot of charts that look like this that are so weak, but the selling is so methodical that it never, I don't know about that, it never massively extends down. But it hasn't touched the ADMA on a single one of these red candles in a row. So I bought some stock into the close yesterday, heavier, trying to take a little bit of a stand on that, and I added to it today. Obviously, it doesn't look good, but the game plan that I have on that is just to liquidate when price touches the ADMA on the daily chart. So hopefully that's with a bounce, but time is against me. So every day that, we go down and move sideways, that ADMA is going to keep going down and down and down. And if my average price is like 1840 something on that stock, just my reward profile is slowly moving down. But I still think it's a pretty good reward profile on the stock that I have given the extension and given the amount of days down. But something's got to break this sell cycle this thing is in. It's been pretty incredible. It reminds me a little bit of that Chewy chart back in here. Remember when this was blowing our minds back in September 23? How do I zoom? Yeah, look at this move here when Chewy broke down at 36.50 and then just worked its way down. And this was an earnings report here. It's only the only bounce it gave was right before that report. And then really what I'm talking about is this move here in September. It just shows you the stock can remain irrational for longer than you can remain solvent. And while it literally is a mathematical law that stocks will eventually have to time or price correct to a point where the ADMA will touch price. Look how many days in a row this was. 1, 2, 3, 4, 5, 6, 7, 8. 8 red days in a row, barely a green day here, followed by 3 more. And how many days was it until you got it went from one touch of the ADMA to the next? So 8, 9, 10, 11, 12, 13, 14, 15, 16 trading sessions. This unity, the way this thing is selling, is actually starting to get there. This is actually now more days down in a row than that Chewy chart was, which is incredible. Chewy did give that one little baby relief day in there. Chewy, it took 18 days from one test of the ADMA to the next. This is, I think it's been 12. 1, 2, 3, 4, 5, 6, 7, 8, 9. Oh no, only 10. Only 10. Only 10. It's still a pretty rare move. But yeah, like Dennis is saying, when you got a stock that's making all-time lows, what does that tell you? It tells you that every single person who has ever bought the stock in the history of the stock is out of the money. So you only have sellers until it reaches a point where the value people can potentially come into play and say, hey, I think that there's actually value at this price, so I'm willing to start investing. I'm willing to start to buy. And personally, I do think that there is value here once you get into this $18, $19 area, and that's why I've started to be a little bit more aggressive with the stock in this area in conjunction with the extension of the technicals. But, me seeing value at 18 could be someone else seeing value at 12. So you got to be really careful with that. Make sure that you're managing your risk appropriately with the trades that you're putting on is basically what it comes down to. But yeah, that unity idea was kind of a failure today. What else? I didn't even really look at some of these ones. Oh, Tesla was great off the open, but look at that. It didn't end up actually closing too well. Hold on a second. Fixed it. Oh wow. I stopped watching this. I wasn't in the trade. I know you guys were looking at it and trading it, even though it was on my list. We talked about being long for the inside and up, and we talked about the importance of the 180 level. And it sounded like, again, I wasn't involved in it between AI and some of these other names that I was trading, a path. I just didn't have the focus to be able to be looking at this one. But it sounded like a whole bunch of you guys were in it, capturing the move. I watched it break through 180. I was like, let's go, guys. I'm glad you're crushing it. And then I didn't see that it actually gave a full V-top reversal on that. So, yeah, it's kind of nasty. That's really nasty, actually, that V-top reversal. And it closed below 180. The stock needs to be 180 in order to feel confident to be above 180, I think, in order to be confident to be long. At highs, though, imagine this candle above 180, when it was at highs, and what this daily candle looked like as it was forming. It looked great. Because you got this, descending wedge here. That's part of a consolidation, with 180 being an important level. You're breaking out of that. And this thing looked like would have looked fantastically with a close above 180, and it just, for whatever reason, it couldn't do it. So we'll continue to keep an eye on this one. I mean, I've had a bearish thesis on the stock, but the technicals tell me what to do. Yeah, I've been saying that I think the stock is worth 70. But let the technicals tell you what to do, because you could easily make an argument that Tesla has been fundamentally irrational for over 10 years, and you can see that when you see over the course of history just how much money has been lost by short sellers in this thing who have been trying to be short for fundamental reasons. So it's good to create a thesis for yourself, but make sure that that thesis is confirmed by the technicals. I think that's pretty much all that I have got, and I am happy to take a look at whatever you guys have. Scrolling up in the VTF first, I think the first question I'm seeing is from Dennis. On you, did you comb through the financials? Yeah, I did. And last earnings, I did, to see if there is still value there, or you're purely going off technicals. So I definitely combine both, because I'm not a fundamental expert by any means. There's plenty of people that are much better than me at it. But yeah, I mean, you're looking at a company that is a profitable company most of the time. Has a lot of growth potential, though. I think that some of the bigger concerns are actually industry concerns, and that's something that Tate had mentioned to us. One of the bigger issues is that last earnings report, which was back here on May 10th. They did a really big restructuring to their business and took a really big like one-time charge. I think it was like 220 million, which is a big charge for the company. And part of that was discontinuing some of their businesses and probably some layoffs. So yeah, I mean that's part of a healing process for a company. I don't necessarily view those one-off restructuring charges as something that's going to be bad for a stock big picture, but it shows you the company is definitely going through some changes, and they had bigger problems actually a while ago when the stock was much more expensive, when they kind of hurt their reputation when they tried to change their model a little bit by charging the developers money in a different way. I don't remember the specifics of the details. Um, that's when the stock was 100% higher than where it's trading currently. So yeah, I do think that there is value here. I don't think that the company is going anywhere. I think that people are still going to play video games, but Tate actually brought up some really interesting stuff just the other day, if he's here, about how the industry itself is changing, and highlighted how Microsoft, which obviously owns Xbox, and you know they're big game players, are shutting down a lot of the studios that actually make games. And the business is changing in such a way where it might not be as profitable for there to be as many video game developers as there were in the past. And video game developers are the people who are actually using this Unity. So if you've got less developers, then Unity is going to have less customers. So Tate brought up some really valuable information on changes in the industry. At the same time as that, I would still note that the gaming industry is massive. It's bigger than TV. It's bigger than movies. So I do think that there is value here. I think there's value at these prices, but it doesn't mean that the stock can't go significantly lower. But at the same time, as you're hitting a point where I think that there is some value, you've got just this huge degree of extension to the downside. No problem. Appreciate the question. Not seeing anything else in the VTF for the moment, so we'll pop over to the YouTube. Gabriel thinks Dell might be a buy on the drop from the earnings report. Jensen on the AI day said, go to Dell for your IT needs. Oh, interesting. I didn't see that. I mean, that's probably what helped boost the stock up from 140 to 180. Maybe it was running too hot in the print. Expectations were really high. Yeah, I think that's what it is. I think that it was the run into the print on this Dell. I mean, you can still go to them for your IT needs, but it still is a computer company. So, we'll see. Also from Gabriel, do you think the huge drop on pending home sales puts a time constraint on the Fed to cut rates sooner than later? IWM and XBI relative strength today are positive, but it might need help from the PCE. Yeah, so we got the PCE tomorrow. We'll see how that comes. I did think it was a good thing to see some slowdown in the housing market. To be honest, we were just talking about this, I think, in yesterday's afternoon meeting about the generation of people who are under 27 years old who are totally screwed as they're entering their housing family formation years and want to be able to buy a house, but prices are at all-time highs and interest rates are at 7.5%. So you can hardly buy a third of what you could have bought in 2021 from a housing perspective. So I think it was actually a really good thing to see some relief there. And it's an extra, I think, piece of data that the Fed needs to be able to start cutting. And I think that the Fed really needs to cut. That's just kind of where my head's at. They need to do it. I know it kind of flies in the face a little bit of traditional economics and what I always learned like back in college when I was an economics major, but as we as traders know, history rhymes, it doesn't repeat, right? And every situation is a little bit unique. And I think that we've never, I mean, I don't think, I know, we've never had a time in the history of finance before when you had a situation where you were having a fast move from 0% interest rates. 0% interest rates have never existed before. So I think it makes it a little bit of a different situation, the current environment, than if you're trying to compare the last time we had a bigger inflation move, which was back in the 70s. I do think though that if you I got a fairly simple solution to be able to get interest rates down, but nobody wants to hear it. It's just stop with the tariffs. And the thing that annoys me about it is it doesn't matter which administration you're talking about. The international tariffs. I mean, when Trump was president, it was tariffs on the EU, tariffs on China, tariffs on everybody. And then Biden becomes president, and these politicians love to, for the most part, immediately erase as much as they can everything that the previous one did when there's a flip in power. And you see that, you saw that when Trump took over from Obama, you saw it when Biden took over from Trump, but he didn't get rid of the tariffs. And actually has increased them and is just always constantly talking about increasing on the trade war. I get it at a certain point with national security stuff, but what was the headline that we just saw a couple days ago? That the Chinese government is initiating a $50 billion government fund for internal chip process building. So they're just going to make their own chips, and the people who were over in China were primarily educated over here, because we also have a big issue with the way that we don't allow highly educated immigrants who come over here and get our they come over here and they get our education, and then we just kick them out of the country. So we kick them all out of the country after they get master's degrees and PhDs from Ivy League universities. And at the same time, we say, no, you can't import any of our chips. So they'll just use our educated people who probably would have liked to have stayed here to kind of build their own. So I don't know. That's just kind of my thought process. But, I definitely understand when you're talking about security that for some industries you need to have laws in place that just protect the populace and protect the country, but it's just basic international economics that trade tariffs are not good for people. So you produce what you have a relative advantage on, and then you trade it for the goods or services that other countries have a relative advantage on, and everybody's better off economically. So, thanks, Kate. I'll take a look at that. How about us losing industry, losing the ability to build our own cars without relying on someone? you got to be able to compete. I mean, the United States. This is my thought process. The United States is based on competition. So if you can't compete, then you can't compete. You know, you look at the tariffs on Chinese EVs that Biden just no, we can't compete on manufacturing, but we compete in other areas that we can trade for, like such as education. That's actually one of our biggest exports, even though they come here to receive it. Um, but you know, think about like a good Chinese electric vehicle, provided that it's built well and everything, that you could get from BYD for $12,000, and you're a college kid and you're trying to afford your $74,000 a year education at NYU, and you barely can, and instead of having to buy an artificially inflated price of a vehicle because it has to be American made, you could get relief by being able to buy a car that's just as good for $12,000. And then that opens up that money for you as a hardworking young person to be able to spend it elsewhere. I mean, I would so I don't want to be overly extreme about it, but I would say that if the American car manufacturers can't compete, then I don't want to say that they don't deserve to exist. They do, and I always think that there will be a business for American car manufacturers, because there will always be people who want to buy American, and there will always be people who want that that American engine, that want that Mustang, that want that Corvette or whatever it is. There will always be demand for that, but companies and the success of companies ebb and flow over time based on their ability to be able to perform. And if they can't compete and they can't perform, then they don't deserve to do as well. I'm not saying that they shouldn't exist. And again, at a certain point, there are national security concerns that you need to take into effect. But just from a basic standard economic perspective, if I can buy the same thing, the same quality good for a cheaper price because it's produced elsewhere, it actually benefits America to be able to buy foreign compared to buying US, because I can take that extra money that I'm making and stimulate the economy into other areas. Um, yep. Yeah, I'm really focusing more obviously on the economics of it, and I'm just kind of straight up saying, hey, if you want to be able to reduce inflation, reduce tariffs, and it benefits everyone economically. But obviously, you have to take into account, at least to some degree, national defense, and I mean, we even saw it to some degree in COVID, like with the drugs, right? Where I guess a lot of pharmaceuticals and drugs are actually produced overseas, produced in China, and then if all of a sudden you fall into a situation where you can't get those drugs, I mean that's a medical need for certain people, but it's all produced overseas. That obviously becomes a problem as well. So like everything else, I think that there's balance, but I also think that there is a large degree of vilification of globalization right now. When the fact of the matter is, one of the reasons why inflation was so low for the entire 2010 decade was because of increasing globalization over the course of those 10 years. And now we're very quickly moving in that other direction. But if you just strictly economically speaking want to bring inflation down, then globalization brings inflation down. And really, I would argue that the increase in interest rates that's come from the Fed has actually done very little in bringing inflation down from 8.5% or whatever we were at highs down to the 3% plus that we're at now. I think that it's primarily come from just getting what's the word I'm looking for? Um, just getting back online the supply chain. So that's the word I'm looking for. Getting the supply chain back online. It just took longer than anybody expected. I think that's where most of the inflation coming back down has actually come from, because the economy's roaring. Raising interest rates certainly hasn't slowed this economy down at all. And I do think that there's at least a degree of truth with what we've also spoken about how to some people, to some parts of the economy, higher interest rates right now are even having an inflationary effect. So yeah, appreciate the discussion with you guys on that. Popping back over to the YouTube. I closed my Dow short from VIXI Bull, but still holding the Q short. I think we will break the bullish pattern today. See how we gap after PCE. From Benjamin Isaiah, can you speak to the correlation between the TLT and index performance? Sure. We spent a lot of time talking about it, but we can do kind of no problem, Bill. We can do kind of just a basic review of things here. So interest rate, all companies for the most part, all big companies borrow money. Even like companies like Apple that probably don't necessarily need to borrow money, they borrow money. It is part of their business model. And when you especially speak about growth related companies, they need to borrow money just for the going concerns of their operation. So the interest rate is a cost of business, basically. Sorry, I just got to fill it on something. The interest rate is basically a cost of doing business. So if you have a higher interest rate, then companies have higher costs. So that's one. And two is the stock market tends to trade at a lower multiple when interest rates are higher. And that's because the free rate of return for money is higher. So in the stock market, I think the historical performance of the stock market, like the historical average performance of the stock market, is like, I don't know, 8%, somewhere in the 8% range. But there's a lot of risk with the stock market. So if on average over the course of a year, and obviously we know that when it comes to the stock market, there's a lot of volatility. So you can have positive 20, 30% years. You can have negative 10, 20% years. But the historical average, as it balances out for like the last 100 years or so, is somewhere around 8%. With all that volatility and all that risk. So if interest rates are 1%, if you can buy a treasury bond and you can get a 1% return on it, that's your free rate of return. That's not great, but you could invest in the stock market, and you'll have a lot of volatility and more risk, but on average you'll get an 8% return. Well, it sounds like you're probably going to be better off in the stock market. But now if you've got your free rate of return at 6%, let's say, you can invest in a treasury bond and get 6%, and the stock market is still going to be that same 8%, but with a lot of volatility and a lot of risk. Well, all of a sudden, the 6% risk-free sounds like a much better deal. So that means that money typically comes out of the stock market and into bonds as interest rates move higher, because the risk-free return is better. And what that inherently does historically, at least the stock markets, though, once again, history rhymes, it doesn't repeat, and it's been a little bit different, I think, this time around as interest rates have gone up for a variety of reasons. Historically, your multiples compress, your PE multiple for the market compresses. So stocks are worth less because there's less incentive to be able to buy because of the risk-free rate. So the TLT, to I guess more directly answer your question, is representative of the price of bonds, particularly longer term 20-year plus bonds, as an ETF, and so it has an inverse correlation to interest rates. So when TLT is down, interest rates are up. When interest rates are up, that creates compression of the multiples, and markets in a vacuum should go down. And then the opposite, right? If TLT is up, interest rates are down, so there's relief to the stock market. More people would be interested in buying the stock market compared to the risk-free rate. So therefore, multiples move higher and the stock market moves higher. It's very simplistic, obviously, because when you get into the nitty-gritty, it's like I was just talking about earlier. Higher interest rates, lower interest rates will have a lesser effect on an Apple that's got more cash than most countries than it will on, think about Uber, which is now profitable, but how many years did it take for Uber to fully finance itself through debt, basically, to hit the point where it was actually profitable, 10 plus years. Who knows if Uber would even be a company if you never had an interest rate environment of 0% rates. There's a good chance it wouldn't be. There's a good chance it never would have been able to get off the ground. So the other companies that are maybe the Ubers of the future that could be profitable 10 years from now, maybe will never be able to even make it if interest rates are high and stay high. So that's how you want to think about it, Benjamin. I think so. Appreciate the question. Next from Gabriel. I tried Tesla today also. It was annoying and I got stopped out. The daily chart was looking beautiful early on. Plus news. Yep. Yeah, that's what we're looking at too. From Apex Joy, what is your view on Carvana fundamentally and technically? I don't really have a fundamental view on Carvana. Don't trade it enough, haven't researched it. It's definitely a growth company. It's performed really well, and the earnings reports have consistently surprised to the upside recently. Technically, it's not looking great in this gap, and I don't like that it didn't perform better today. It should have been able to perform better today because a lot of these types of companies did a little bit better today. But I don't like that trading the gap. So this thing looks like it could work down to continue the gap fill, which is all the way down to 92.50. It's below the moving averages. The moving averages are crossing. So I think that Carvana is a do not touch right now on the long side until it sets up better or fills the gap, and is possibly even a short right now on good setups, which I think we even talked about this yesterday. It might have been in our internal meeting. I think someone asked me yesterday morning about a Carvana short. And I said, I like it because it's in the gap, but I don't like that you're chasing a day 4. If it can bounce a little bit, if it can bounce, this is literally what I said, I think, in the morning meeting yesterday when somebody asked me about it. If it could bounce like the 105 to 107 area, there might be a short there for a lower high. And look at that. It's actually what played out today. So it's interesting. From Gabriel, Microsoft is a huge gaming player. They bought ATVI. They bought Activision. Thus they own Warzone and Call of Duty. These really addictive games with huge amounts of players worldwide on a daily basis. Revenue comes from the Battle Pass buys. Yeah, I haven't played Call of Duty since I was in college. Constant revenue streams, plus they release add-ons based on collaborative with famous people. The other day you could buy a Snoop Dogg skin. It's cool. Battle Pass are renewed every 2 months. Cool. Thanks for the info there, Gabriel. Thanks for the commentary, Steve. From Rome Lee, I wanted to start learning more about option flow, specific to the Qs and the SPYs. Not to take trades quite yet, but just to learn markets better. When you look at flow, where do you start? Well, I start by looking at it in the VTF because we get it posted in there. So again, you can reach out if you want to become a member of the team or get a subscription to that. But when it comes to option flow, the big things that I'm looking for, and you got to parse it through the noise a little bit, and I think Pat even does part of that job for us, is consistency of flow and anything that's particularly unusual, and ideally things that are unusual and consistent, where you're getting both at the same time. That seems to be what matters more. And when you see like a NVIDIA ripping higher, and you might even say to yourself, like, man, I really want to short this at a certain point because of the extension. A great thing to recognize is, wow, the bullish option flow is still coming into this NVIDIA very consistently, which means that you're potentially jumping in front of like a gamma squeeze, and that's something that you want to be very careful about. So I think that option flow is a great thing to look at. I consider it to be more of a layer of probability than anything else. I don't want to say I never buy a trade or get involved in a trade specifically because of option flow. I occasionally do, but for the most part, I prefer to utilize it as like a layer of probability than anything else. A layer of probability for when I like other things. From Rome, should I look at 0 DTE more or contracts further out? Kind of a vague question, so a vague answer is fine. Yeah, you want to pay attention to both. I do think that things that are more recent on their expiration have a more immediately larger impact than things that are further out. But you want to pay attention to both. Thanks for those questions. From Bill, big things I look for, just to say things you didn't mention. The closer the expiration matters. Yep. Whether or not the sweep is opening or not. Yeah, that's great information there. An opening sweep. And whether earnings are within the expiration or not. Yeah. Thanks, Bill. 3 important pieces of information. The closer the expiration, that matters. Whether or not the sweep is opening, and whether earnings are within the expiration or not. Thanks, Bill. All right. BurgerFi to consider strategic alternatives. I don't think I've ever been to a BurgerFi. And from Pat here, an opening sweep is the size of the order is greater than the amount in the open interest. You can check the open interest the next day to confirm. Thanks, Pat. Well, all right, ladies and gentlemen, it's 5 o'clock. I think we got through everything for today. So I'll wrap it up. Have a great night. If you're on YouTube, give me the thumbs up. Tell all your friends. And I will see you all tomorrow, where we will wrap up the week and wrap up the month.